big mission for all of us this morning, our taxes. Yes, tax day over a month away, but you should not put it off any longer, especially when you hear the tips our next guest has for you. So please welcome Stephanie Grunehagen from Davidoff, Hutcher, and Citron with some little-known deductions that could be saving you money, and also a deduction you may want to avoid. So let's get into, first of all, what we should be make sure we use. Healthcare. What can we deduct?
Okay, so for healthcare, any insurance premiums that you pay above and beyond what's taken out of your paycheck or that your employer pays can be deducted. Of course, there's limitations. Also, some of the other medical expenses, if you have a few surgeries in a year or a big expensive medical year, you can aggregate those together.
But you have to have a certain amount. You can't have a little. Yes, it has to be a big amount of medical expenses. Yes. But if that's you can save some money there. What about sales tax?
So sales tax is interesting because most people know that you can either choose the standard deduction or itemize your deductions, in which case you would deduct the amount of state income tax you pay. But sales tax is kind of like this secret third option that you may not be aware of.
Okay.
It's typically useful if you've made a big purchase or two during the year, maybe a car, maybe an engagement ring, maybe it's a good year and you got both.
Yeah.
But if the amount of sales tax is above and beyond and you're going to itemize, you can take that deduction instead.
Interesting. That could be a big one. What about disaster recovery? Who qualifies for that, and how much can you actually get?
So for disaster recovery, there's actually worksheets that the IRS will provide, because especially with named storms and the extent of the damage in the area, there may be different limitations and guidelines. It's any amount that is not recoverable by insurance if you haven't been paid for your house, your personal property, your vehicles. Again, there's kind of guidelines and there's limitations on both ends, but basically if it's something you lost and you weren't reimbursed for, you'll be able to take a deduction for that amount in between.
And the idea is we're telling you these things so then when you go do your taxes or have someone do them, you can say, hey, by the way, and kind of remember some of these things too. What about the lifetime learning credit? How does that work?
The lifetime learning credit is great. And again, this is a credit, not a deduction. So a deduction reduces the amount of income that you'll be taxed
Taxable,
on,
right.
and a credit reduces your actual tax. So it's great.
Straight up money.
Yes, it's dollar for dollar, you get that amount. So it's great because it's eligible. People are eligible if they're 25, 35, 75
but
years old.
Are there rules? I mean, do I have to, spend a certain amount, or how does that work?
The first $10,000 you spend, it's 20% of that. Again, there are limitations for income and that kind of thing, but you don't necessarily have to be going towards a degree. So if you're taking classes at the local community college, that could work.
Okay, another one that we talk about, student loan deduction. That's one. But a lot of people that pay student loans know this one. But I want to make sure we get to the home office deduction. You say this is one you want to be very careful with.
Right. So it used to be, hey, I'm taking a home office deduction, audit me. But now, if you're very meticulous with your records and you are using that space for an office and you have everything documented out, separate entrance, separate phone line, make sure you're meticulous with your records if you want to take that deduction.
Take the deduction, but have your records, have your proof. Stephanie, thanks so much for coming in. Some good tips. And of course, tune in tomorrow. Another Picks Financial Fix. Same time, same channel, same place. All right. Time now, 6:59, News at 7 starts now.